Welcome to the Modern Husbands Podcast, where any combination of Dr. Ross, Christian, and Brian host national experts who share winning ideas to manage money and the home as a team. Today we discuss how to find the right financial planner. Our guest is John Stoj, who brings 30 years of Wall Street and small business ownership experience to his clients at Verbatim Financial, the flat-fee registered investment advisor he founded in 2019. Decades in finance taught John that banks, broker-dealers, insurance companies, etc. do not have their customers' best interests in mind, but only their profits. So he's dedicated to increasing financial literacy and preventing as many people as possible from being taken advantage of. John also founded flatfeeadvisors.org as a resource for folks looking for financial advisors who manage investments for a flat annual fee rather than a percentage of assets under management. John is a 2023 Plutus Award Finalist for Best Financial Advisor Content Creator. Enjoy today's show. John, thanks for joining us today.
Oh, thanks for having me, Brian. I really appreciate the opportunity.
So listeners have asked us to help them understand how to spot investment scams. And we're not talking about just like the clowns on TikTok selling high fee annuities, but financial planners who are incentivized more by what's going to earn them higher commissions than perhaps what's in the best interest of our listeners, of the investors themselves. But before we get to that, would love to provide context for our listeners by, if you wouldn't mind, you taking a moment to walk us through your career journey, starting with college.
Sure. No, I appreciate that. I think we all like to talk about ourselves. I'm going to try to keep it as quick as possible and as short as possible. I think, I grew up in a typical small town. It was a great childhood.
Where did you grow up?
Little town in New Jersey.
Okay.
And it really was this idyllic blue collar town, kind of like a Happy Days kind of thing. I mean, we had the Little League teams, and we had our own kindergarten through 8th grade school that everybody in the town went to, and so it was just a fantastic place to grow up. In the Bruce Springsteen era. In the Bruce Springsteen era, yes. I mean, oh my gosh. In fact, one of my greatest regrets, which I guess you could say that I'm pretty lucky if this is one of my greatest regrets, but one of my greatest regrets is not having gone to see Bruce during the Born in the USA tour at Giant Stadium. I just think that, I passed on it at the time. It's like anything else. I was rebelling. As a teen, I was rebelling against how popular he was in 1985. So, and now I regret it, but it is what it is. But got out of there, went to college at Notre Dame. Had a fantastic experience. In fact, unfortunately, was there during our last national championship all those many years ago. But it was super fun. And
Lou
got
Holtz,
out of
right?
college. What's that?
Lou Holtz? Was that his
Holtz,
team?
Yeah. Really, it was the glory days of Notre Dame football for sure. It was a lot of fun. Graduated from college and I went straight to work on Wall Street. Frankly, more by luck than anything else. I had a friend who had been working internships at a brokerage, and he called me up one summer, the summer before senior year, and he said, "What are you doing for a summer job this year?" And I said, "I don't know, hadn't decided yet." And he said, "Can you get into the city this afternoon?" I hopped on a train. I went in, got a summer job, and went right back there after graduation. And so that was how I got started, sort of in the Wall Street career. And then after that, it was just sort of the standard progression. I started out on a trading desk, which may not have been standard, but it was a bond trading desk. Did that for a while. Went back to get my MBA. Did that at the University of North Carolina, Chapel Hill, which, by the way, I was there also pretty lucky. He was there when Jerry Stackhouse was there, and it was a
Vince
fantastic.
Carter.
Yep, and it was
Wow.
So
Hold on. So let me make sure I understand this. You were in New Jersey during the Bruce Springsteen era. Then you went to Notre Dame in the Lou Holtz era, and then you went to UNC during the Jerry Stackhouse, Vince Carter, and then Dean Smith was the coach.
Yeah.
So you've had kind of like this golden road paved for you. Wow.
Yeah. I managed to somehow continue getting off on the shoulder myself, but the road was there, that's for sure. And actually, it was funny when I was trying to decide what I wanted to do after business school. One of the bond salesmen that I worked with, he sat me down because I wanted to be a trader, not a salesman. And he sat me down. He said, "John, you might want to consider sales because I mean, you talk about Notre Dame football during part of the year, you talk about North Carolina basketball the rest of the year. You're pretty much set."
That's right. But if you're a trader, I mean, you're like, are you one of those guys on the floor who is always on the front page of the financial news that looks like they want to cry if the market's down? Did you have one of those jobs?
I had, in a sense, I did. So bond trading and bond trading floors are different than the stock exchange, and so we looked at different. I had we had all these screens in front of us instead of showing different brokers and different bonds available for trading. But I definitely did have some days that I wanted to cry. Usually when my head trader was yelling at me for some reason. But it was a fantastic trial by fire, big education into the ways of Wall Street. And that's, it's funny what you take away from different opportunities and different experiences. And my first job, that first experience on Wall Street, really set the tone for the rest of my career, frankly. And I look back on it now with a lot of thankfulness that I had that opportunity.
How so?
Well, it taught me how Wall Street thinks of the average Joe.
That's important. Okay, and yeah. Which is what?
Which is not much. So really, and I don't want to criticize the good folks that I know that are, say, working that people consider Wall Street types working as financial planners and advisors who are doing just great work for their clients. But I'm thinking of Wall Street itself, the traders and the salesmen who sling stocks and bonds around. They see themselves as up here, and the rest of the people, the John Q. public, as down there, uneducated and frankly easy to take advantage of. And so that's something that stuck with me. I never did like it. I didn't like that attitude, and it's something that caused me to, as I was able to move my career along, to get out of, again, that sales and trading side of the business into the money management side of the business, where you could take responsibility and attempt to protect your clients instead of taking advantage of them.
Okay, so walk the everyday listener through what the difference of those two things would be.
Okay, so so Wall Street has all the information. Now, things have changed. When I started, you didn't have. I mean, we're talking the early '90s. People didn't have, their phones attached to apps that allowed them to see everything with the markets all the time, or all the different tools we have on our computers nowadays. But at the same time, even though we have that, Wall Street still has an advantage. They still have Bloomberg terminals, which are these amazing information sources, and real-time quotes and immediate access to whatever's happening worldwide, market-wise. Wall Street has that. The average person does not. And even if you were to put a Bloomberg terminal on your desk and pay however many thousands of dollars it is a month, I can't even, I don't know what it is nowadays, but you wouldn't know what to do with the information because we all have responsibilities. We have our own lives to live. We can't be concentrating on that. These guys are focused on it, and their whole job is to wring as much money out of whatever transaction they're attempting to do as possible. And so that's a part of the business. Your job is to make as much money as you can in whatever transaction you're working on. Now, the good part about it is that if you're working on an institutional basis, and that means you're working company to company, not with individual investors, then in a sense, it doesn't matter. If I'm working at Bank X and I'm trying to outbid or outdo Goldman Sachs on a trade, hey, great. Who cares if Goldman Sachs loses a little, or heck, they might pull one over on me. It is, these are firms that are competing for profits. But as soon as you inject a real person in there, a real person, their savings, their retirement, whatever, then to me it becomes a different type of issue where you can't think of it that same way. I don't want to think of it that same way. I want to think, okay, well, how can everybody benefit? And that's not really the way Wall Street thinks of it, in my opinion, overall.
As you explained that process, I think our listeners would benefit if we perhaps looked at it from two perspectives. So the first perspective would be folks who think that they can make a living or they can have a side hustle as a day trader. And you see it, all over social media. And it for whatever reason, it doesn't dawn on them that in most instances, the counterparty to one of their trades is somebody who went to the best schools like a Notre Dame, and they're focused on one singular thing, and they have access to information that you don't have access to in real time. And somehow people think that you can out trade them, which, am I wrong? That seems ludicrous to me. Am I wrong?
No, it is ludicrous. You use a good word. You'll always find exceptions that can outperform, quote unquote, outperform the market or make money trading for some period of time. But as you extend the length of time, the percentage or the number of folks that can do that, it drops off a cliff. And the interesting thing is that also applies to institutional professional money managers. Active fund managers can't even outperform the market on a long-term basis. And S&P puts out a report on this. It's called the SPIVA report, and they'll look at that. The performance of active fund managers versus passive or index investing, and that you're talking single-digit percentages of professionals who can outperform over a long-term period versus an individual like you or I. Extremely difficult. This isn't to say that I didn't try it. I did. I traded my own stock portfolio for a while. And I also thought I was really good at it for a while, until I wasn't. And then I realized that my excellent performance was more due to luck and timing than any sort of advantage that I had.
And so for our listeners, that I want to make sure that y'all understand that the difference between day trading and active fund management. So the day trading is people that, think they can get on to E-Trade or whatever, and they can be stock pickers. They know more about the market than the professionals, and they can get in and out based on whatever intuitions they think they have, which statistically speaking, you might know somebody that's done it. There's all kinds of people on social media that claim they do it, yet they have to work on social media. So figure that one out. But that's ludicrous. But then you have active fund managers. And this, I want to talk more about this because this is something that is going to be more commonly faced by the everyday Joe, where somebody sits down and tells you that, hey, I can manage a portfolio in a way where I will rotate, I will have asset rotations, I will get in and out of assets based on, market rhythms and patterns, et cetera. And over, I saw a statistic that over 30 years, that 99% of the time, if you just invested in the S&P S&P 500 index fund and just let it ride, you would have outperformed those actively managed mutual funds, because in large part because of fees, but also because it's really hard to time the market. Is that right? And if so, can you perhaps elaborate a little bit more on what those financial planners who push that, why it is that they're pushing active fund management?
So one, overall, you're entirely correct. And the reason for that is quite simple. None of us know the future. You can't succeed in giving someone additional performance based on something that's unknowable, and the future is unknowable. This doesn't mean that we throw up our hands and just do nothing. You do need to ideally actively manage your entire financial world, your finances, your personal finances, yes, but not to the extent that you are actively picking stocks, timing the market, picking bonds as well. As we're finding, we're seeing finally there's movement, significant movement in the bond markets over the last year or so, and after a almost 20-year period of in a sense stability, but stability at zero interest rate. But to go back, yeah, the idea that anybody can do that consistently is just an unrealistic idea. Day trading is, in my opinion, gambling. It's nothing more than that. If somebody wants to do it and they allocate a certain portion, a small percentage of their savings to that, and it's entertainment for them, hey, there's some other forms of entertainment are actually more expensive than that. However, if you think you're going to, do that with your retirement savings, your nest egg, I would caution against it greatly. And then, so that's part one. Part two is, as you mentioned, the active management that may be recommended by financial advisors or firms that promote these things. They're promoting those ideas largely because that's how they make money, and it's not, and they make money in a couple of different ways. They make money through the fees that the funds charge to everybody who holds those funds, and so I'm not sure what the average actively managed fund fee is, but when you're talking about index funds that charge fractions of a percent, so a basis point is 1/100th of a percent, and an index fund might charge you 4 to 7 basis points, so a tiny fraction of a percent each year, versus a actively managed fund, which might be 0.5%, or even you can still find, oddly enough, you think it'd be crazy, but you could still find people who have funds that are charging a full percentage point or more within their portfolios. And to me, it's really sad because it's not. I don't think it's justified in any way. And if you think about that, imagine if you're paying a 1% fee on your fund each year, and what if the fund only returns 4%, because we're potentially entering a period where the markets aren't going to grow at the rate that they were over the last, say, 10 years. Then you are giving away 25% of your return.
Right.
every year in that fund. And so, you're compounding the issues with that type of strategy, compounding the negatives, not compounding in a positive way. The negative being that one, you're potentially investing in some sort of actively managed fund that we know statistically will not outperform the market on any sort of long-term basis. And then you're adding on top of that the fact that you're paying a massive fee each year on those funds. That's really a recipe for an amazing drag on your portfolio, and that can cut significantly into your savings over the course of your investing career.
I think it's really important to highlight the fact that a 1% fee is really on, when looking at returns, if you earned 4% in the market, a 1% fee is actually a 25% fee, because that's not how it's shaped by financial planners. What they'll say is it's 1% of your overall investment, not your return, but it's your returns that you need in order to compound and build wealth. And that 1% fee crushes your returns. And this leads us into the driving question of, how is it that you can spot a financial planner who is not going to put your best interest ahead of their own? What are the signs, the questions, the credentialing?
Well, so that's a really good question. And it's an important one because it's difficult to say that there's any one thing that's immediately going to tell you yes or no that this person is truly acting only in your best interest as a client. So the word that you'll want to think about is, probably heard it before, maybe you hadn't, but fiduciary. So if people have heard that term bandied about, you want your financial advisor, planner, whatever, to be a fiduciary. So you can ask, if you're looking for somebody, you say, are you a fiduciary, or will you be acting in a fiduciary capacity, with me if we work together? And there are different ways that theoretically you can attempt to assure yourself that this person is a fiduciary. Investment advisor representatives who work for RIAs, which stands for Registered Investment Advisors. I can't stand the jargon and all the little acronyms, but if you're working with an advisor who works for an RIA, they are supposed to act as fiduciaries for you as a client. If you're working with an advisor who works for a broker-dealer, which would be, again, something like a Goldman or a JP Morgan or something like that, they may or may not be acting as fiduciaries. They are supposed to tell you when they are and when they're not, because they can be they can have a dual mandate to sometimes sell products and sometimes act as a fiduciary.
Wait a second. So hold on a second here. So these people who work for X bank, I'm not going to name banks. They all have them. They are incentivized by that financial institution to push certain products onto their customers. Is that right?
There are often incentives to sell certain products over other products. You will always, the word used, I don't want to use the word always, but often you will not be surprised if you worked for Bank X and a client came in and you had a choice between placing that client into two different funds, each of which do basically the same thing, invest in, say, the same assets, generally speaking. Then the fund that is issued or managed by your bank or institution is going to be preferable to that institution, right? And so you, as the advisor, are probably going to be incented to sell your own firm's funds over other funds, which may or may not be superior or cheaper in a way. And so these are things to, obviously to be aware of when you're working with someone, with a professional.
Now, are you a CFP?
So I am not a CFP. So CFP is a certified financial planner, and it's a great training program. CFPs are extremely knowledgeable about different aspects of financial planning and investments. And so I am not a CFP simply because it is something that I don't feel is valuable for me, for my clients. But that just happens to be because I've been in the business since 1992. I believe that CFPs are extremely important to look for if you are wanting to work with someone who's maybe younger, a little bit younger, who doesn't have all of the industry experience, but they are smart. They're interested in the business, and it's to me, it demonstrates a level of competency for sure. So I recommend that people look for folks with CFP designations if that's what they're looking for.
A quick moment of appreciation for our sponsor, Money Marriage University, who delivers self-paced online courses for couples designed by national therapy and financial planning experts. Money Marriage U experts understand how to help couples hurting from arguments and tension around money. Money Marriage U offers a wide variety of online courses at different price points. Take your first step toward healing your pain by visiting moneymarriageuniversity.com. Once again, you can learn more at moneymarriageuniversity.com. Now back to the show.
So what is the credentialing, or what are the series of questions you need to ask as the everyday Joe to understand whether or not the financial planner, advisor is legally bound to put your best interests ahead of their own, which is the fiduciary standard?
Yeah, so there's really just two questions that I would ask. The first is the easiest one that I mentioned before. Are you and will you act as a fiduciary? I believe that most folks, other than say insurance agents who are promoting themselves as advisors, they will say that, yeah, hopefully they'll say that they're acting as a fiduciary. But the other thing that you need to look at, in my opinion, is simply the business model of whomever that you want to work with, and just find out how they get paid. And that's the easiest. That's the easiest way to know, and frankly, not just for financial advisors, but for almost any type of business, right? If we know how folks are getting paid, then we can pretty much suss out their incentives and whether their incentives are aligned with ours as a client. And so you'll want to know, all of the different ways that an advisor gets paid. Are they paid through commissions? Are they paid only through their fees? So are they fee only?
Explain what fee only is.
So fee only is another interesting topic, because it's to me it's part of a movement from what was probably the most conflicted way of paying financial professionals, which is commissions based. If a professional is being paid via commission, then the only way they're going to get paid is if they sell you something. And we know that certain products are going to pay higher commissions than other products. So then you always have to wonder in the back of your head, well, why are they recommending this product to me versus that product? Is it only is it because of that, it's the better product, or is it because it's the better paying commission product? So Wall Street operated on commissions, and for the longest period of time, just on commissions on stock or bond sales to clients, and that became, people saw that became problematic. The conflicts of interest were, front and forward in front of everybody in that respect. So then the idea of fee only came up. So to try to remove that commission-based conflict of interest, we'd say, okay, we're going to charge you a fee on your assets under management, and so usually a percentage-based fee. Say it's still around 1%. We used 1% as an example earlier, but I wasn't talking about this fee. I was actually talking about fund fees at the time. But here's another layer of a percentage fee that could come out. And so you say a 1% fee on your assets under management. That's the only way that the advisor or planner is compensated. And so you can be more assured as a client that the advisor isn't incented to recommend, again, one product versus another, one stock versus another, one fund versus another, because they're going to get paid that same percentage fee regardless of which product they recommend to you. So that's a positive step forward, and it reduces the conflict of interest between the advisor and the client. There are other fee models that advisors work under. I happen to work under a flat fee model where I do not charge a percentage of a client's assets under my advisement or management. I just charge one flat agreed upon fee for my services each year. That's a way that I feel better about how I can communicate the value that I provide for clients. But it's all just about how can you assure your client, and how, if you're looking for an advisor, how can you feel assured that the advisor is going to act, again, in your best interest, not in their best interest.
Yeah, as you were talking about, incentives and how they can distort advice, and then as a result, understanding how people get paid. That's essential. And I love your fee-based model, which frankly has to be very hard for you, but for the consumer, I love it. But it's everywhere. And I've learned that in running Modern Husbands when I founded it. And you can make all kinds of money with affiliate links with like credit card companies and banks. And I won't do it because now I've gone from someone and a community where we're just simply trying to support Modern Husbands to help provide and protect in whatever way that looks in their partnership, in an unbiased way, to me being incentivized to push certain products, or the products that are linked aren't necessarily the best for that person. And you see it with, no offense to the nerd wallets and Credit Karmas, and that's how they generate revenue. And so people should also be have their eyes wide open when they go online and just explore basic financial products, understanding that they perhaps are clicking on links where in the background, that credit card company is paying out that website for promoting that product. So I want to dive into one last financial product, which over the last, it feels like at least 6 months, I've seen this surge of insurance salesmen pretending to be investment folks. And it's all over social media. And frankly, friends of mine have been sold a bill of goods by somebody, a salesperson, simply telling them that we can make sure you don't lose anything. We're going to protect what you have, but you'll still gain money. You're still going to get returns from the market, but there's no way that you can lose anything. So can you explain, first of all, that's too good to be true. So anytime somebody says something like that, like instantly you should red alert, right? Like that's nonsense. Can you explain what kind of product these people who are saying these things, which oftentimes are insurance salesmen, are actually doing? What is that product?
So I believe you're talking about IULs, which is an insurance product called an indexed universal life insurance product. It's an update to the whole life life insurance product. These are permanent cash value life insurance products. And what that means is when you think about life insurance, there's basically two types. There's term life, which you purchase for a fixed period of time, and ideally you pay for it to protect you or your family against the loss of your income due to your
Right.
loss of life.
Yeah.
And ideally, they never pay, right? Because you don't want to die during
Right.
that period of time that you've insured it.
And I have to interject here. Term life insurance in
Yes.
most instances is very affordable. I think I pay $50 a month and it covers a tremendous amount of income.
Yeah, term life insurance is usually a quite affordable product. Obviously, everything depends upon your health and age and stuff like that. But
Yeah.
And it's affordable because they don't pay out a lot. But that's okay. Again, in my opinion, that's okay because that means
Yeah.
you didn't die during a period of time when your family needed you. So you were there instead. That's better. Another life insurance product are these cash value or permanent life insurance products, where in theory, or more than in theory, they build up a value, and as long as you continue paying your premium, they will pay you something when you die, of course. You can also access some of this value that builds up over the years beforehand. And that's what these salesmen are talking about, different strategies to access cash value within a life insurance product. These are, however, hybrid products. I cringe when I hear a life insurance product spoken up of as an investment. It's a product. There's nothing wrong with products. There's nothing wrong with insurance. There isn't even necessarily anything wrong with cash value insurance, but especially the way you see it promoted on TikTok nowadays, more than anything else, it's really, really upsetting to me as a financial professional because it gives us all a bad name. In my opinion, because of folks use the term financial advisor. There isn't a lot of sort of legal requirements around using the term financial advisor. Basically, anybody can call themselves one, and so it's a little sad, but it is what it is. And when I see folks promoting these products as alternatives to 401k savings or IRA savings, it's troublesome for sure, because of while they are products that will do what they do, they're not inexpensive, and they're often some of the most expensive ways to accomplish what you want to accomplish. So and going back to what we talked about earlier, reducing expenses, whether it be in the form of fund fees or any other kind of fees that you can look to lower over time. That's how you're going to set yourself up better for the future versus getting roped into something that is a high fee product versus, again, a lower fee product.
And is this IUL? It's a type of annuity, correct?
No, it's a life insurance product.
Okay.
So
okay.
annuities are yet another type of insurance product, but IULs are life insurance products.
Okay. And when you look at the fees baked into IULs, it's not uncommon when you consider the fees within the investments themselves, plus the fee earned by the company who built the product, for those fees to be 2, 3, 4%. Is that correct?
Well, they can be these products are incredibly complicated, and so it's extremely difficult to suss out an exact fee. And also because there are all these different triggers within it. There are surrender periods where if you were, say, to sign up, a surrender period is a period where if you were to buy this IUL, and then decide a short period of time later that this was a mistake, you've paid X dollars into it already. Well, you don't get your money back. You have to wait and pay in for another certain period of time before you can get your money back out of that product that you put in. And so that would be a massive fee if you had to surrender it prior to the end of that period. So there's just different ways where these fees can sort of hide and come up and sometimes go away, and they're just overly complex for what they're being sold to do. I am a big fan of separating specific products for their specific needs. If you want life insurance, get life insurance. Get the appropriate amount of life insurance for as little money as you can pay for it, from as high a quality of an insurer as possible. And that's probably going to be term life insurance. It's probably not going to be a permanent or cash value life insurance product, because then you're mixing those up. If you want to access the returns of a stock index, and that's where they're talking about when the name of that product, an index universal life, they're tying the performance of this fund that you are accessing to an index, but it's also not directly tied. It's so complicated. It's not even funny. And so all of these things work together to create frictions and fees and inefficiencies that really make them sort of less appropriate, much less appropriate for folks than it's being made out to be.
So I want to conclude with perhaps you sharing a little bit about your family dynamic. Like you're from New Jersey, you're this Wall Street guy, and I'm from a rural town in Ohio. So at least where I grew up, men, they were responsible for bringing home the bacon, right? They were the provider and the protector in a literal sense. But that's not the way that most marriages work anymore, because, now, unlike the 1950s, women work outside the home. And as a result, there needs to be partnership in marriage, not these like strict perceived gender norms. So can you perhaps just share a little bit about how you and your wife work together to manage money in the home and parent? You have a child, correct?
Yeah. We have a 9-year-old son, so lucky enough to have him. I think we have from a financial standpoint, we have a typical situation where one of us, in this case it is me, maybe not, spoiler alert, I'm financial advisor, but I'm the more not money savvy, but I'm more interested in the money side of our family, and working with clients and families, that applies 90% of the time. There's always one of the partners who's more, and it isn't necessarily just the man. I have plenty of clients who either the wife or if they're same-sex partners, there's just one of the folks who takes the lead on the financial side. So I do that, but my wife knows what she makes, and she knows generally where it's going. And the interesting thing, I think, for us is that we have a financial advisor. Although I am a financial advisor, I think my wife's a physician, and just like how they say, physician, heal thyself is not possible. So she goes to the doctor. Well, I go and we have a financial advisor because of, I think it's always important to have that second opinion, that other set of eyes looking at your situation. And so we communicate with our advisor much like couples communicate with me, which is that, the whole family has to be aware of what's going on, but there's always going to be a point person. And we share responsibilities the way it makes sense for us. She works at the hospital really long hours, crazy schedule. So once we had our son, it became more my responsibility to be the parent who was able to take him to school, pick him up, soccer games, all that kind of stuff. And that works for us. I often think to myself, I don't know how families who have, two working parents without one of the jobs being flexible. I don't know how they do it, frankly, because
with stress.
I know, yeah. you get stressed. And it's not weird for me to be that parent, even though I still there's enough of a I don't call it stereotypical because that's going away, as you mentioned. But I'm still one of the few dads who show up with all the moms to either pick up or drop off the kids. But for some reason, it was never a big deal for me. And I think it was because I was lucky because my dad sort of did a lot of that when I was a kid, even though this was growing up in the 70s and when it was more traditional. He set an example by he always made our lunches. So my school lunch, my mom's school lunch, because she was a school teacher, and his lunch. He made our lunches every day, and he cooked on the weekends. And he retired before my mom did. And as soon as he retired, he took over all of the cooking in the house. And so, there were these sort of, he never had an issue crossing what was thought of as those kind of gender norms, barriers, if you will, way back in the day for me. So it just never occurred to me for it to be an issue either.
No, I can tell you that I love being at all of my kids' stuff, and I actually like to cook. If you were to kind of give our listeners one piece of advice that they can walk away with that is applicable to their lives right now, it's easy to carry out, what would it be?
I would say simplify as much as possible. I have a quote on my website from Einstein, I think, is supposed to have said it. Whether he really did or not, no one knows. But my dad gave me this quote on a piece of paper that he cut out from a magazine back in probably 1983. And it says, things should be made as simple as possible, but no simpler. Because obviously we can always take things a little too far. But when we're thinking about our finances, simple is almost always better. The more complicated it is, the more opportunity there is for mistakes to be made. The more opportunity there is for people to take advantage of you, to lose money to fees, to these complicated products like IULs or anything like that. If you can't understand it, it's not. I'm going to tell you this right now. If somebody brings you an investment idea, and that includes a quote unquote investment idea like an IUL, if you can't understand it, it's not because you're not smart enough. It's because it's too complicated. And there's no reason for it to be too complicated.
Well said. What a great way to end today's podcast. John, thanks so much for joining us.
Oh, thanks for having me, Brian. I again, like I said, I really appreciate it.
A special thanks to our guests and, of course, to all of our listeners. Don't forget to click subscribe wherever you download your podcast. Give us a rating and share our podcast with others. And check out our website at modernhusbands.com, where you can find articles, courses, toolkits, and other resources to help you and your partner manage money in the home as a team. Until next time, be well.